Hey everybody, it's Seth and Paul for Everything Money. Welcome to the channel. By the end of this video, you will know the financial health of Netflix as a company. Its financials, its trends. Paul, my dear friend Paul here, is going to analyze using our 8-pillar systematic analysis of a stock to tell you about the PE, the profit margin, the revenue growth, the profit growth, the number of shares they have, their current assets over liabilities, their free cash flow, and what final number we'll come up with to see if Netflix is over or undervalued. But first, we ask for you guys just to tickle that like button. Just pretty please go ahead and give us an early thumbs up. Paul, how are you doing? I see you're sitting in your Mexican villa. How are you, my dear friend?
I noticed you always ask me a question and then you just keep talking.
No, I was quiet.
How are you doing? I see it. I'm just like, oh, okay, I won't answer now.
I do that. You're right. Whoops. Anyway, Paul is in Mexico. I'm in Ohio. I'll be joining him later this week, and we will be going live from Mexico next week. But today, we're going to analyze Netflix. Paul, obviously, Netflix is enormous. You love it. I love it. I don't know anyone who says Netflix is terrible. It's been a great company. Before the show started, we were talking about how I got some killer stock advice in around 2005, 2006, when a colleague of mine told me just to buy companies I really like. And I got in Netflix incredibly early. I sold it. I got some sort of turnaround around 300%. And it was a big gainer for me, and it was actually taking up a lot of my portfolio, which is why you advised me to sell at that time. But regardless, obviously the stock has exploded. The company has exploded. What are your thoughts on this company?
From a standpoint of the company itself, they've done an incredible job of creating lots of great content. I mean, look at Queen's Gambit. That's been, and as a chess player, I think I'm the only person in the world actually who did not like the show. I shouldn't say I didn't like it, but it wasn't as exciting for me. I actually wanted less chess and more story, which is kind of funny.
Yeah.
But I mean, on a Saturday night, what am I doing? On a Friday night, what am I doing? I don't go to cable. I go to Netflix and go, okay, what's on Netflix? Let me start looking for stuff. You know what I mean? And I think it's awesome. You just said before the show, who doesn't have Netflix? And their subscriber growth is still like pretty awesome. You know what I mean? That's the funny part about Netflix.
Yeah, they got a lot of room to grow, I think. And like you said, I mean, my family and I sit around watching YouTube TV. We found out that we can't watch Cleveland Indians or Cavs games. So it's like, well, we're just going to switch off TV. There's nothing on anymore, at least in my mind.
I think that's wrong, by the way, Seth. You have to be able to. I remember looking at YouTube TV once, and they had all the local sports channels.
Either way, let's rock this out. Folks, we are going to use... We are going to use our 8-pillar analysis. We're going to start right now. Paul is going to show you the ins and outs of the financials. If you're drawn to math and numbers, not just stock trends, feel free to pay attention and stay tuned, because by the end of the video, we'll show you what you think. Paul, let's get to the numbers here. Pull up what you got here. What is the market cap?
All right, guys. So one of the first things we look at is market cap. So this is the actual price of the company. I never look at stock price, because stock price is merely the value of the company divided by the number of shares, and they can change the number of shares very easily. So I just look at market cap, $234 billion, which means if you wanted to buy this company today, it would cost you $234 billion to own it outright. Okay. PE ratio. We like to be in the 15 to 20 range. Historically, the average is 15. This is at 85. So it's 5.7 times higher than the historical average for the market. So that's an X there on PE. Profit margin, we want over 10%. That is over 10%. It's a check mark there. And even better, this is after taxes. Don't forget, guys. So they've already paid their income tax and a pretty nice gross margin of 40%. So far, we have one X on the PE and one check mark on profit margin.
Pillar number three is revenue growth over the past 5 years. Paul, I'm sure this is pretty good.
I'm quite sure this is going to be huge. So let's pull up our revenue growth in the last 5 years. 6.8 billion to 20 billion. That's 3 times more. That's exactly 3 times more revenue in the last 5 years.
Pillar number 4 is profit growth. Paul, I would assume this is absurd as well.
Massive check, 15 times higher, 122 million to 1.9 billion.
What about pillar number 5 is the shares outstanding, Paul? We want this number going down, and it doesn't look good.
No, and this is what I figured for a fast-growing company like this that has a very high-growing stock price, very fast-growing stock price, they do have more shares. And the reason being is their comment is going to be, well, our shares are overvalued. Let's use those shares to generate cash. And there is a good argument to that. Like, if your stock is overvalued, give people your shares as a way of acquiring businesses. Because let's say, for example, your stock is overvalued by 5 times. A good CEO will sit there and say, okay, if our stock should be 10, but it's selling for 50, every time I use our $50 shares to buy something, I'm essentially buying them with I'm essentially paying $10 for it. That seems a little weird to think about. I don't want to get too much in the nitty gritty, but they aren't increasing the number of shares by too much, and they are overvalued. So it could be a decent argument for using that. Now, I still don't like them having a habit of increasing shares, but it is there nonetheless.
Pillar number 6 is current assets greater than current liabilities.
All right, basically $10 billion in current assets. Current assets are basically the cash on hand that the company has. And current liabilities are $7.9 billion. So they have over $2 billion extra in cash to their current liabilities. So check mark there.
Pillar number 7 is the granddaddy of them all, Paul. Your favorite is free cash flow. Why is this so important?
So free cash flow, guys, is what the company will use to buy shares back, pay dividends in the future, and also just make acquisitions and grow further. So free cash flow is the money that's actually coming in, because earnings on the net income side are manipulated through different rules according to the SEC and GAAP policies and other accounting rules. Free cash flow, even though it can be manipulated, is actual cash in hand. You can't, overall, the cash is the cash. You know what I mean? Now, they can manipulate it in other ways, but free cash flow is cash from operations less capital expenditures. Now, here's the deal. They haven't had cash from operations in years, and this shows you how net income can be so different from actual cash in. Last year, they made $1.9 billion, but their cash from operations was a loss of 2.9. So for both free cash flow growth, it's a negative, because they went from a 900 million free cash flow loss to a 3.1 billion free cash flow loss. So that's a loss. That's a bigger loss. That's an X. And there is no free cash flow multiple because their free cash flow is negative. So X and X there. Now, this is the same thing that Amazon had years ago. I want everybody to remember that fast-growing companies that spend a lot of money growing and acquiring users are going to have this problem. Did I think it was going to be this bad? No. Am I touching the stock? For me personally, guys, I'm avoiding this, and here is why. I like to buy stocks and companies that have a more established, we're done with our major growth, let's start paying our investors back, either through dividends, share buybacks, or growing the company and making the balance sheet much better. That's not happening here. Does that mean it's not a buy? No, but for me, I'm looking at it now. I do want to share, Seth. Now, as you can tell, even though there's no free cash flow, I still have a price for the company, because the company is still growing like crazy. So there is something to be paid for the company. I'm coming up, though, with a price between $95 and $200, so basically $100 to $200. And this factors in a very, very high revenue growth number. Now, $200 per share assumes this 33% revenue growth continues on for the next 5 years, which probably isn't very likely. Is it possible? Absolutely. But is it likely? I don't know. So I still think this company is overpriced by quite a bit, but it doesn't mean you should avoid it completely. You should keep it on your radar. But from a free cash flow perspective, that's where there might be more research that a guy like me would do, saying, okay, how much of this how much of the cash from operations is being affected because of them trying to grow a ton? They're trying to they are the number one streaming provider out there. The question is, how do they make sure they control that and now can generate free cash flow? That's the biggest question I have. For a guy like me, this probably isn't a company I'm buying right now, unless it fell into this range, which is a big drop from today. And a lot of people look at this video saying, Paul, it's not going to drop there. Maybe, maybe not. I just go back to history and look at 2000 and 2008 and every other market bubble out there. Stocks do fall a lot, and it tends to be the high-flying stocks that drop the most. I'm going to wait for one of those opportunities for me to buy this stock. I love Netflix. I think they're going to generate a lot of free cash flow in the future. It's going to be awesome. But right now, it's just too much for me to buy it, even assuming these kind of revenue growth numbers. Does that make sense, Seth?
Yeah. So just to recap, everybody, the PE is a little high. Obviously, their profit margin is great. Their revenue and profit growth is great. They are issuing more shares. They do have more current assets over liabilities, but they have no free cash flow, and thus we can't use our pillar number 8, which is price to free cash flow. I mean, Paul, as a normal person hearing this great analysis, I see a stock price of $530 and your target price of $95. What do you say to people that say
by the way, it's 95 to 200. I don't know the exact number. It's just, that's where I'm sitting there trying to get my certain. And by the way, that's assuming a 15. Remember, I'm a value investor. If I went to, let's say, a 10% discount rate and a future PE of 20, that goes to $300 a share, just like that. Remember, guys, every model is built on assumptions. I can change my assumptions right here. So I just got the $300 a share pretty quickly. by assuming a 10% return per year and a future PE of 20. And that could be a very reasonable argument by somebody saying, listen, I only need to make 10% of my money. And this is a fast growing company that is going to dominate the market. I'm willing to pay a premium for it. Great. Pay $300 a share. But my whole point is it's still expensive at this price. But it was at $300 a share earlier this year. So maybe it's a company that you just needs to fall a little bit to get back to earlier this year prices, and you're okay with it. Does that make sense, Seth?
Yeah, if you're watching this right now, you probably are thinking what I'm thinking. Gosh, how do I get to this? How do I get this 8-pillar analysis? And how do I get that amazing spreadsheet? Paul, tell people how they get more access to you.
Well, so I pay $500 a month for access to that information, but we are currently building our own website and app to be able to do all of this for you. It'll be roughly $25 a month versus $500 a month. You'll be able to put in any stock. It'll merely give you the 8 pillars and which ones are X and which ones are checks. But if you want access to it for free, join our Patreon. Anyone who's an active Patreon member right now will get access to the website and the app for free as long as you're an active Patreon paying user. And right now, the cheapest Patreon level is $8 a month. You literally pay $8 a month right now. And the next 3 or 4 months, when the website comes out, you get the website for free. And we're going to continue building the website and making it better and better as time goes on.
Our Patreon's gone crazy, Paul. I don't think it's been even up for even 2 months yet. We have like 120 people in there. You guys get access to our Discord channel. You get access to Paul. Paul and I do uncensored videos just for patrons, which we'll be doing next week. And so we welcome you to join our community, and we thank you for watching this video. In general, Paul and I are both staying away Netflix at the moment, but it's obviously a great company, Paul. You can love the company.
Love the company, and just wait for the right price to own this wonderful company.
As always, guys, make sure you smash and like, subscribe. We put out so many videos a week, and our channel is growing off the moon. It's going to the moon, Paul. It's like Neo and Tesla. We're just going to keep skyrocketing to the moon, and with your help. So thanks for watching, guys. Love you. Thanks, Paul. Appreciate it.